There's a moment in financial history that almost nobody talks about. March 1980. Silver hits 50 an ounce. Not because of inflation, not because of some gradual market trend, but because two brothers from Texas decided to corner the entire global silver market. They nearly succeeded. They accumulated over 200 million ounces. They controlled roughly half the world's deliverable silver supply. And for a brief, insane moment, they held the financial system hostage. Then it all collapsed in 17 days. The Hunt brothers lost 1.7 billion. That's 6 billion in today's money. Silver crashed from 50 to 11. The exchange had to change the rules mid-game to stop them. It was the last time anyone tried to squeeze silver on that scale. Until now. Because in 2026, something is happening that makes the Hunt brothers' scheme look like a practice run. The physical silver market is breaking. Not from speculation, from something far more dangerous. Industrial demand that cannot be met. A supply deficit that cannot be filled. And a price discovery mechanism that's about to snap. Let me show you why silver could hit 150 by summer. Not from hype, from math. And why the story of 1980 is the exact blueprint for what's coming. Except this time there's no one to change the rules because the shortage is real. Let's start with what actually happened in 1980, because most people get this story completely wrong. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, were Texas oil billionaires. Old money. Their father, H.L. Hunt, was one of the richest men in America. In 1973, the brothers started buying silver. Not as an investment, as a hedge against what they saw coming. The dollar had just been disconnected from gold. Nixon closed the gold window in 1971. For the first time in history, the dollar was pure fiat currency backed by nothing. The Hunts believed inflation would explode. They believed the dollar would collapse. And they believed silver was massively undervalued. They were right about all of it. By 1979, they had accumulated over 100 million ounces of physical silver. They weren't trading paper contracts. They were taking delivery. Bars stored in vaults in New York and Switzerland. Real metal. But they didn't stop there. They also bought silver futures contracts on the COMEX exchange in New York. Futures are promises to deliver silver at a future date. Most futures traders never take delivery. They close their positions before expiration. It's a paper game. The Hunts broke the game. They bought futures and demanded delivery. When a contract expired, they took the silver off the market. Month after month, the Hunt brothers drained physical silver from the COMEX warehouses. By late 1979, the exchange was in crisis. There wasn't enough silver to deliver against all the contracts. The price started to spike. In January 1979, silver was 6 an ounce. By September, it was 11. By December, 20. By January 1980, 35. On January 17, 1980, silver hit 50. In 12 months, it had increased more than 700. The Hunts didn't cause the entire move. Inflation was real. The Soviet invasion of Afghanistan spooked markets. But the Hunts accelerated it by removing supply from a market that was already tight. They had cornered silver. And here's what people forget. They almost won. If the price had kept rising, if the squeeze had continued, the entire commodities exchange system would have collapsed. Banks that had sold silver short were facing unlimited losses. Brokerage firms were on the edge of bankruptcy. The financial system was breaking. So the powers that be changed the rules. On January 21, 1980, the COMEX announced new trading restrictions. They called it Silver Rule 7. It stated that traders could only liquidate positions, not open new ones. You could sell, but you couldn't buy. Think about what that means. In the middle of a market, the exchange banned buying. They rigged the game to crush the squeeze. Without new buyers, the price collapsed. By March, silver was back to 11. The Hunt brothers were ruined. They had borrowed billions to buy silver, using the silver itself as collateral. When the price crashed, they got margin called. They couldn't pay. They had to sell everything. They declared bankruptcy in 1988. The largest personal bankruptcy in American history at that time. The story became a cautionary tale. Don't try to corner markets. Don't fight the system. The exchange will change the rules, and you will lose. And for 45 years, that lesson held. No one tried to corner silver again. But here's the thing. The Hunts were early. They had the right thesis. They just didn't have the one element that makes a squeeze unstoppable. They didn't have structural demand that couldn't be turned off. In 1980, Silver was mostly used for photography, jewelry, and silverware. Industrial uses existed, but they were flexible. When the price spiked to 50, industries cut back. They used less silver. They found substitutes. Demand was elastic. In 2026, that's no longer true. Today, over 60% of silver demand is industrial. And the largest growth sector is the one sector that cannot cut back. Solar panels. A single solar panel uses roughly 20 grams of silver. That doesn't sound like much until you understand the scale of solar deployment happening right now. In 2000, global solar capacity was 1 gigawatt. In 2010, 40 gigawatts. In 2020, 760 gigawatts. In 2024, over 1,600 gigawatts. The growth is exponential. And every government on Earth is mandating more. The EU has targets. China has targets. The US has subsidies. India is building massive solar farms. This isn't speculation. This is policy. By 2030, the solar industry alone will consume over 200 million ounces of silver per year. That's 20% of total global mine production. But here's the problem. Silver mine production is not growing. In 2024, total global silver mining produced roughly 830 million ounces. That number has been flat for 5 years. There are no major new silver mines coming online. Most silver is mined as a byproduct of copper, lead, and zinc. You can't just increase silver production. You'd have to mine more of the base metals. And those industries are driven by their own economics, not by silver prices. Meanwhile, total silver demand in 2024 was approximately 1.2 billion ounces. That's a deficit of 370 million ounces. The gap is being filled by above-ground stockpiles. Silver that was mined years ago and stored in vaults, warehouses, and ETFs. But those stockpiles are shrinking. The COMEX silver warehouse inventory has dropped 86% since 2020. In 2020, there were roughly 400 million ounces in COMEX warehouses. Today, there are barely 50 million ounces. The Shanghai Futures Exchange is seeing the same drain. Silver is leaving the warehouses and going into solar panels, into electrical components, into 5G infrastructure, into uses where it will never come back. You can't recycle the silver in a solar panel. It's too diffused. It's gone. This is the setup that didn't exist in 1980. This is structural demand that cannot stop. And if the price spikes, it won't reduce consumption. Why? Because the cost of silver in a solar panel is negligible. If silver goes from 30 to 150 per ounce, the cost of a solar panel increases by maybe 5. That won't stop deployment. Governments are subsidizing solar. The mandates are locked in. The factories are built. The supply chains are running. Solar deployment will continue regardless of the silver price, which means demand is completely inelastic. This is a squeeze that can't be broken by killing demand. Now let's talk about the supply side. Because the real crisis is what's happening in the physical market versus the paper market. Right now, you can buy silver in 2 ways. Physical metal, bars and coins that you take possession of. Or paper contracts, futures and ETFs that represent claims on silver but don't require actual delivery. The price you see on financial websites, 32, 35, whatever it is, that's the paper price. It's set by futures trading on the COMEX in New York. The COMEX trades billions of dollars in silver contracts every day. But here's the key. Over 95% of those contracts are never delivered. They're closed out in cash. It's a paper game. The actual physical silver traded on the COMEX is a tiny fraction of the contract volume. This works fine in a normal market. But when physical supply gets tight, the system breaks. Because paper contracts are theoretically backed by physical silver in the warehouses. But the ratio is insane. At any given time, there are roughly 200 paper claims for every ounce of physical silver available for delivery. That's called the leverage ratio. It means that if just one of contract holders demanded physical delivery, the system would fail. There isn't enough silver. For years, this didn't matter because no one demanded delivery. Traders are happy to settle in cash. But starting in 2020, something changed. Retail investors started buying physical silver. Not contracts, actual bars and coins. The Reddit Wall Street Bets community tried to squeeze silver in 2021. They called it the silver squeeze. It didn't work because they were too small and too unorganized. But it revealed the fragility of the system. Premiums on physical silver spiked. Dealers ran out of inventory. Mints couldn't keep up with demand. For a few weeks, you couldn't buy physical silver at any price near the paper spot price. The disconnect was obvious. The paper market was saying silver was 25. The physical market was saying we don't have any. That event was a warning shot. Since then, central banks have started buying silver. Not gold, silver. The Chinese government has been accumulating silver quietly. India has increased silver imports. Wealthy individuals are taking delivery of large positions. And the drain on the COMEX warehouses has continued. We're now at the point where the physical market is priced differently than the paper market. Dealers are charging premiums of 6 to 10 per ounce over spot. That means the real price of physical silver is already 38 to 42, not the 32 paper price. This is the exact same dynamic that the Hunt brothers created in 1980, except they had to buy hundreds of millions of ounces to do it. Today, the market is doing it to itself. Here's where the math gets dangerous. Let's assume solar demand continues growing at current rates. Let's assume mine production stays flat. Let's assume above-ground stockpiles continue to decline. At some point in 2026, probably by summer, the COMEX warehouses will hit a critical threshold. If inventory drops below 30 million ounces, the exchange will face a crisis. Because at any given time, there are contracts representing hundreds of millions of ounces traded. If even a small fraction demand delivery, the exchange cannot fulfill them. This is called a delivery default. When a futures exchange cannot deliver the physical commodity it's supposed to represent, the contract becomes meaningless. The paper price becomes irrelevant. The only price that matters is the physical price. And the physical price is set by whoever has metal and is willing to sell. In a shortage, that price can go anywhere. In 1980, silver went from 11 to 50 in 3 months. That was a 350 increase driven by 2 guys and some leverage. In 2026, we're facing a structural supply deficit that affects every solar panel manufacturer, every electronics company, every military contractor, every electrical grid operator. The buyers who need physical silver cannot stop buying. The sellers who have physical silver have no incentive to sell cheap. If you're holding 10,000 ounces of silver and you know there's a shortage, why would you sell at 50? Why not wait for 75? Why not 100? This is how squeezes accelerate. The Hunt brothers pushed silver to 50 and the exchange stopped them by changing the rules. But how do you change the rules when the shortage is real? How do you ban buying when industries need silver to function? You can't shut down solar panel factories. You can't stop 5G deployment. You can't tell the military they can't have silver for missile guidance systems. The demand is non-negotiable, which means the price has to rise until supply comes back into the market. But where does that supply come from? There are no secret silver vaults. There's no strategic silver reserve. The only source is higher prices pulling metal out of jewelry, out of old coins, out of industrial scrap. But that takes time. And in the meantime, the price can spike far higher than fundamentals would suggest because the market is in panic mode. Let's talk numbers. Bank of America put out a research note in late 2024 projecting silver could hit 65 by mid-2026. That's a conservative estimate based on supply deficits and solar demand. But Bank of America is assuming normal market function. They're assuming the COMEX doesn't default. They're assuming paper contracts keep working. If those assumptions break, if we see a delivery crisis, the price doesn't stop at 65. In a true physical squeeze, silver could hit 100 by summer 2026. If the panic spreads, if large buyers rush to secure supply, it could go to 150. That's not hype. That's what happens when a commodity that's essential to industrial production becomes unavailable at any reasonable price. You want a precedent? Look at palladium in 2001. Palladium is used in catalytic converters. In 2000, Russia, which supplied 40 of the world's palladium, restricted exports. Supply panic hit the market. Palladium went from 300 per ounce in 1999 to over 1,000 per ounce in 2001. That's a 230 increase in 2 years. And palladium is a tiny market compared to silver. Or look at rhodium in 2021. Rhodium is another catalyst metal. Supply tightened. The price went from 2,500 per ounce in 2019 to 29,000 per ounce in 2021, an 1,100 increase. These aren't hypothetical scenarios. These are real markets where supply shortages caused price explosions. Silver is facing the same dynamic. Except silver is a much larger market, much more critical to global infrastructure, and much more visible to investors. Now let's connect this to the bigger picture, because silver doesn't exist in a vacuum. The reason the Hunt brothers bought silver in the first place was because they believed the dollar was collapsing. They were reacting to Nixon closing the gold window. They were reacting to inflation. They were reacting to a monetary system that had lost its anchor. Does any of that sound familiar? In 2020, the Federal Reserve printed $5 trillion. In 2025, the U.S. national debt is $36 trillion. The deficit is $1.8 trillion annually. Interest payments on the debt are approaching $1 trillion per year. The dollar is losing purchasing power. Inflation is entrenched. And every time the Fed tries to raise rates to fight inflation, something breaks. Banks fail. Markets crash. The government can't afford the interest payments. So they cut rates again. And inflation comes back. This is the exact same monetary chaos that drove the hunts to silver in the 1970s. Except now it's worse. In the 1970s, the U.S. was still a manufacturing power. We still had a trade surplus. We still had room to maneuver. In 2025, we're running an $800 billion trade deficit. We're dependent on foreign supply chains for everything. We're the world's largest debtor. And the reserve currency status of the dollar is eroding. BRICS nations are developing alternative payment systems. Saudi Arabia is accepting yuan for oil. Central banks are buying gold at record rates. The foundation of dollar dominance is cracking. And when the dollar loses its status, when foreign holders start selling U.S. treasuries in dollars, where does that money go? It goes into hard assets. Gold, silver, commodities, things that can't be printed. This is why silver isn't just an industrial story. It's a monetary story. In a world where fiat currencies are failing, where central banks are printing without limit, where government debt is unsustainable, people flee to tangible assets. Silver is both. It's an industrial commodity that's in shortage, and it's a monetary metal that's historically been used as money. That dual role makes it incredibly dangerous for the paper market. Because once the narrative shifts from silver as an industrial metal to silver as a monetary hedge, the buying pressure becomes unstoppable. You're not just competing with solar manufacturers. You're competing with every investor who wants to get out of dollars. Let me give you the timeline of how this could unfold. Right now, in early 2025, silver is trading around 32. The COMEX warehouses have roughly 50 million ounces. The supply deficit is growing. By spring 2026, solar demand accelerates. China ramps up panel production. The U.S. subsidies kick in. Industrial buyers start competing for supply. The COMEX inventory drops to 30 million ounces. At that level, a few large buyers demanding delivery could trigger a crisis. Maybe it's a Chinese manufacturer securing 6 months of supply. Maybe it's a sovereign wealth fund taking a position. Maybe it's a group of billionaires coordinating like the Hunts did. It doesn't matter who. Once the squeeze starts, everyone rushes in. By June 2026, the COMEX is in crisis. They announced trading restrictions. But unlike 1980, they can't just ban buying. The industrial buyers sue. The solar industry lobbies Congress. The restrictions get challenged in court. The paper market loses credibility. Investors abandon futures and buy physical. Dealers run out of inventory. Premiums explode. The price hits 75, then 100. Mints can't produce coins fast enough. Refiners are backlogged for months. Physical silver becomes almost impossible to buy at any price. Panic spreads. Gold starts moving too. The entire precious metals market goes into mania mode. By August 2026, silver is at 150. The media is covering it daily. Everyone who ignored it is scrambling to get in. The Hunt brothers are mentioned in every article as the cautionary tale of what not to do. But this time, there's no one to blame. It's not a manipulation. It's a structural shortage caused by decades of underinvestment in mining, massive industrial demand from the green energy transition, and a monetary system that's collapsing under the weight of debt. Eventually, the price rise will pull supply back into the market. Jewelry gets melted down. Industrial users find substitutes where possible. New mines get developed, but that takes years. In the short term, 6 to 12 months, the price could stay elevated at levels that seem absurd. And then, just like 1980, it will crash. Because squeezes always end. Supply comes back. Demand gets rationed. Speculators who bought at the top get wiped out. Silver could drop from 150 back to 60 in a matter of weeks. The cycle completes. But here's the difference between 1980 and 2026. In 1980, after the crash, silver went back to being an irrelevant side market. In 2026, after the crash, the structural deficit remains. Solar demand isn't going away. The green energy transition isn't stopping. The supply shortage is permanent until new mines come online, and that's a decade away. Which means silver could crash from 150 to 60, and then slowly grind back up to 100 as the deficit reasserts itself. This isn't a one-time spike. This is a repricing of a commodity that's been undervalued for 40 years. So what does this mean for you? If you believe this thesis, if you think the supply deficit is real, if you think the monetary system is unstable, then the window to position in silver is closing. The Hunt brothers bought when silver was 6. They made fortunes before the crash. The people who bought at 45 got destroyed. Timing matters. Right now, silver is 32. The COMEX still has inventory. The crisis hasn't started. You can still buy physical silver at reasonable premiums. But by the time the shortage becomes obvious, by the time the media is covering it, by the time your neighbors are talking about it, it'll be too late. The dealers will be sold out. The premiums will be 20 over spot. You'll be chasing a market that's already gone parabolic. The smart money buys before the crowd. The smart money understands the pattern. And the pattern from 1980 is clear. A structural shortage plus a paper market that's over-leveraged plus a catalyst that forces delivery equals a price explosion. We have all three elements in place. The shortage is real. The paper market is leveraged 200 to 1. The catalyst is solar demand that cannot be stopped. The only question is when. My guess, summer 2026. The math says the COMEX inventory will hit critical levels by then. The solar demand will be peaking. The industrial buyers will be panicking. And once the first default happens, once the first major buyer can't get delivery, the cascade starts. Silver goes from 32 to 75 in a matter of weeks. From 75 to 150 in a matter of months. And everyone who ignored it will spend the rest of their lives saying they should have seen it coming. The Hunt brothers saw it coming in 1973. They were 7 years early, but they were right. The dollar collapsed. Inflation exploded. Silver went to 50. They just couldn't hold through the crash. This time, you don't need to corner the market. The market is cornering itself. All you need to do is recognize the pattern and position accordingly. If this analysis makes sense to you, if you see the same structural imbalances I see, then don't wait for confirmation. By the time silver hits 65 and Bank of America's prediction comes true, the easy money is gone. The 10x move happens before the crowd arrives. It happens when people like you, right now, make the decision to pay attention to the math instead of waiting for the headlines. The Hunt brothers were called crazy until silver hit 50. Then they were called geniuses. Then they were called bankrupt. The lesson isn't don't buy silver. The lesson is understand the cycle, position early, and don't overstay. We're at the beginning. The shortage is building. The inventory is draining. The price hasn't moved yet. That's the opportunity. Subscribe if you want to follow how this unfolds, because when silver starts moving, it's going to move fast. And the story of 1980 will be told again, except this time we'll be watching it in real time. And this time, the people who understand the pattern will be ready.